You know how it is. You're scrolling through your feed, you see a picture from your friend's vacation, a funny dog video, and then, bam, someone's giving you a hot stock tip. If that sounds familiar, you've seen firsthand how financial advice has totally changed. It's not in some stuffy bank office anymore. It's right there, in your pocket. So let's get into it and figure out what's real promise and what's, well, pretty serious peril.
I mean, we've basically seen a revolution happen right before our eyes. The old way, it was formal, it was slow, kind of like advice being handed down from on high. The new way, it's fast, it's interactive, it's built around personalities, and something can go viral in just a few hours. This isn't just about changing the channel, it's a completely different language and speed for financial info.
So what do we even call these new folks on the block? Finfluencers. Yeah, it's a simple mashup of finance and influencer, but don't let the name fool you. It represents a super powerful new kind of creator who's trying to explain everything from mutual funds to stock options, and they're doing it in like 60 seconds.
But why did this explode all of a sudden? Well, it was really the perfect storm. First, you've got this huge financial literacy gap in India. Get this, only about 27% of people are considered financially literate. And at the same time, you had this massive wave of new, young investors who were hungry for information they could actually understand. It created this huge vacuum, and you know who rushed in to fill it? Finfluencers.
And when I say boom, I mean a boom. The number of DMAT accounts, the accounts you need to trade stocks, it nearly tripled in just 2 years. Think about that. This wasn't some small trend. It was a tidal wave of new investors hitting the market, and every single one of them was looking for a little guidance.
Okay, so we've got this explosion of content, and we've got a super eager audience. But let's be real, this isn't just about sharing knowledge out of the goodness of their hearts. There is a very sophisticated business model working behind the scenes, and you absolutely need to understand it.
Which, of course, brings us to the million-dollar question, or in some cases, the multi-million-dollar question. Sure, there are brand deals and courses, but how are a lot of these finfluencers really cashing in on their advice? The answer, more often than not, is something called affiliate marketing.
So, the most common setup is affiliate marketing, and it works like this. A finfluencer partners up with a stockbroker, they get a special link that's unique to them, and then they share it all over social media. Every time one of their followers clicks that link, signs up, and starts trading, the influencer gets a piece of the action. Simple as that. But how they get paid is really revealing. Cost per lead means they get paid just for you signing up. Cost per acquisition is a step further. They get paid when you actually put money in the account. But the really tricky one is revenue sharing. That's where the influencer earns a percentage of the fees you generate for the broker. Now that creates a huge incentive for them to encourage you to trade more often and maybe even make riskier trades.
So here's the bottom line. This whole phenomenon is a classic double-edged sword. On one side, you've got this incredible promise of making financial education accessible to millions of people. But on the other side, well, there's some very real danger lurking just below the surface.
Let's start with the good stuff, the promise. Finfluencers have really broken down some super complex topics, making them easy to digest and, honestly, kind of entertaining. They've sparked an interest in finance and brought a whole new generation of investors into the market, democratizing financial knowledge in a way the old-school institutions just never could.
But here's the flip side, and financial planner Suresh Sadagopan just nails it with this quote. The very thing that makes the content so catchy, that sensational, exciting vibe, can also be what makes it so dangerous. It can push viewers towards really high-risk stuff, instead of, a solid long-term strategy. And then there's this number. Wow. It's just staggering. They're all out there giving what sounds an awful lot like financial advice, but only 2% of them are actually registered with SEBI, the official market regulator. That leaves a massive, massive gap in accountability and, frankly, qualifications. And the results of this can be devastating. A full 90% of regular retail traders lose money in the super high-risk futures and options market. That's a part of the market that finfluencers often make sound exciting, full of quick gains. But the reality for almost everyone? It's significant losses.
So with the risks being this high and with so many investors losing money, the regulators just couldn't sit back and do nothing. The Securities and Exchange Board of India, or SEBI, decided it was time to step in and try to bring some order to all this chaos. So what's SEBI doing? Well, their new rules are designed to get right to the heart of the problem. First, they're cutting off the money trail between brokers and unregistered influencers. Done. Second, they're putting a stop to those live trading videos by making them delay any market data. And third, they're demanding total transparency, which means influencers have to tell you exactly how they're getting paid. Okay, so the regulators are finally making their move. But what does all of this mean for you, the individual investor trying to figure things out? It means you need a new playbook. It's about being empowered, not just influenced.
So instead of just jumping on a hot tip you saw online, smart investors are focused on the fundamentals. Take a concept like position sizing. This is a core risk management strategy. It's not about what stock to buy, but how much you should buy based on your own money and how much you're willing to risk. It's disciplined, it's mathematical, and it is the complete opposite of that go-all-in hype you see all over the internet.
So, who is actually watching all of this content? It's fascinating. A study actually broke down the audience into 3 very different groups. You've got the skeptical professionals, the action-oriented followers, and the cautious learners. Let's dig into each one.
First up, we have the cautious learners. They're about 19% of the audience. Think young students. They watch a ton of content, and they generally trust the person making it. But, and this is the important part, they almost never act on the advice. They're using these finfluencers as a way to learn, to build awareness, not as a trading service.
Next, we have the biggest group of all, the skeptical professionals, coming in at 47%. These are experienced folks, working professionals. They might watch the videos to see what's trending, but their trust level is super low. They're going to do their own research or talk to a certified advisor. For them, a finfluencer is just one tiny piece of information and not a very reliable one at that.
And finally, we have the action-oriented followers, about 35% of the audience. This group is really interesting. They often have high incomes and are eager to make their money grow, but maybe they don't have the time to do deep research. They trust finfluencers, and they are very likely to actually act on the advice they see. And because of that, this is the group that regulators are most worried about because they're the most vulnerable to bad or misleading information.
And that really brings us to the final and most important question. This isn't about judging any of these groups. It's about being aware of yourself. In this brand new, fast-moving world of viral financial advice, the most powerful tool you have is understanding your own biases, your own trust levels, and your own tendency to act. So the big question you have to ask yourself is this: which investor are you?